When we talk about NBFI, non-bank financial institutions, you go to many jurisdictions and you realize that they all have different meanings. When you take the global definition of non-bank financial institutions, then it tries to talk about the non-deposit institutions, and that generally we know that banking institutions, and for that matter banks, were the original institutions that were taking deposits from the public. And therefore, as a non-bank financial institution, the first thing that comes is that you are not taking deposits. But this particular definition has a jurisdictional connotation. You go into some jurisdictions and you will realize that there are some of the institutions who take deposits. So it depends on which jurisdiction that you are having this conversation. But generally, we will live here appreciating that non-bank financial institutions are all the financial institutions and players other than commercial banks. So that is the broad picture we will want to look at. And the conversation we are having is, why do we want to build and continue to sustain the Moja Loop community? It's because we will want to get to the last mile. We will want everybody to get involved in the financial ecosystem. And because of this, let's look at the other side of the players. And so quickly, we will be looking at the features of these institutions that we are talking about. You will realize that these non-banks do not have banking license. But you go into some jurisdictions and you will realize that they do everything as the commercial banks do. And actually, there are some players, when you come to Ghana here, there are some players called the savings and loans companies who operate just like commercial banks, except forests. You have community banks who operate everything just like commercial banks, except forests. And you will have also the pension institutions. You will have the capital market players within and all this. So they will normally not have the universal banking license. Again, you are looking at how they are regulated. When you go to various jurisdictions, you see that how these non-banks are regulated is a bit different. It's either they are being given a lower capital requirement, they are also not required to submit to the Basel principles, or even if they are required to follow the Basel principles, then you realize that the commercial banks will be on Basel III, whilst these institutions are Basel II or 1. So it is a different kind of institutional arrangement. Another key thing has to do with the market they serve. And you will realize that these non-bank institutions focus on the bottom of the pyramid. When you look at the pyramid, that is where the majority of the populace are, especially in emerging markets, especially in developing economies. You will realize that these are the places that you will find most of the non-bank financial institutions. In mature markets, you are going to find the commercial banks playing a lot of the roles with some linkages. And you will see that in those matured economies, those at the lower of the pyramid, we do not actually take care of them because they are not actually key in the development of the economy. But today we will realize that they play different role. And in every jurisdiction, generally you have the banking sector, you have the pension sector, you have the insurance, and then the capital market players. When you go to some of the Southern African countries, you see that pension and insurance is considered as one vehicle. But if you come to Ghana, they have different portfolio, and therefore, when you are talking about insurance penetration, how you measure it in some regions of Africa or on the world market will be a bit different because of how we have aggregated them. So, just as we have mentioned, if you come to the conversations we're having, you will realize that there are the deposit-taking institutions who are not commercial banks or universal banks. And I was privileged to visit Kenya and Uganda last year. And I saw how they were trying to build the non-bank sector with various schemes and the use of the cooperatives. And today in Ghana here, I heard the government saying that going forward, they will want to focus on the cooperative system of helping the farmers to even get access to credit. So talk about the leasing companies, talk about the remittances, and you will realize that almost everybody in this room, in one way or the other, has been working with any of these. And that is the more reason why we need to pay attention to them. And I tried to look at some of the key players within Africa. You realize that even when you go to the Eastern African region where you have Equity Bank in 1984 started as a non-bank, actually as a cooperative, and it grew into what it is today, and one of the leading players there. If you go to Nigeria, look at UBA, it actually, as it tries to go into different markets, it goes to look at the non-bank sector and transition it into the next level. In Ghana here, you have a number of the banks who did not start as commercial banks, but they started as NBFIs. And so it is a market that each and every one of us, regulators and policy makers, we need to pay attention there to look at how we will support that sector. For instance, if you look at the mobile money space, look at what M-Pesa is doing, look at what MTN is doing, look at the partnership with Airtel Tigo. How do we leverage on their services to reach the last mile? We are talking about financial inclusion here. And look at the SACCOs. Go to some of the countries, you will realize that the infrastructure is being built by the funds from these SACCOs. Transportation system, the community systems are being built by these people. Carrywise, actually in Nigeria, is doing a lot of things, helping people to even invest in the market, the capital market. And actually, when you look at Ghana here, EcoBank with Pan-African Savings and Loans collaborating to look at how they can help people to even use MTN mobile money to invest in the capital market. So this is the kind of future we are looking at for the space. The likes of Baobab, the likes of Lesheho. In Ghana here, actually, the biggest non-bank financial institution is Lesheho, which actually processes 34,000 credits every day. 34,000 loans every day. So it tells you the kind of services these non-bank institutions are offering. And can you imagine if we pay attention there and we collaborate with them? We want to reach the last mile. And this financial inclusion we're talking about here. MFS Africa, look at Wave in Senegal, and the likes. Another thing that I also want to draw attention to is how For instance, Ghana here, the middle tier non-bank sector looks like. In Ghana, we have in the banking space, we have the three categories. We have the universal banks, and we all know universal banks, the commercial banks, and what they do. And then we have the middle tier who support the SME sector. And in Ghana here, we have what we call the savings and loans companies. Its resemblance is the deposit taking in Kenya, the deposit taking MFI in Kenya and Uganda. If you look at Nigeria, you're looking at the microfinance bank at the federal level. The microfinance banks at the federal level. If you go to other jurisdictions, you see them in the middle tier. Those are the ones in Ghana here. And then you come to the microfinance, the lower tier in Ghana here. And I will want to invite you to spend some time while you are in Ghana here to learn more about how the non-bank sector operates over here and the relationship it has with the regulator and how we are developing the sector going into the future. What are the roles that we play? The non-bank sector, you have the pensions, you have the insurance, you have the capital market players, you have the banking, the non-bank sector. Then you realize that this is the sector where financial inclusion is really, really the case. Because the commercial bank's architecture looks at profitability and where it makes business sense to operate from. But that micro institutions looks at where they will reach the last person. So they are the ones that we will need to look at to see how do we support them. They are the ones who are supporting the households and the SMEs. These are people who are looking for $5, $10, $100, and you can't go before a commercial bank saying, I'm looking for $10. The energy, the efforts that will go in, it's so much that they would rather not to do it. But we have seen these days that they are now downscaling, which tells you the need for us to pay attention there. The economic growth, social improvements, it's saving households. One of the regions in Ghana here, we have what we call the Ashanti region. That's the middle part of the country. There is an institution there called Sinapi Yaba. It has a relationship with the Opportunity International. And also you have Opportunity International Savings and Loans here. These institutions create a particular product called the Spousal Support Scheme. What is it? That when you are a woman who comes to take a loan, they also build the financial capacity of your husband. If you are a man who comes to do business with them, they will have to also arrange to build the capacity of your wife so that the household becomes better. And these are institutions supporting the youth. Just last month, one of them launched what we call the Youth Startup Credit, so that the youth who want to start a business will go there for credit. They are actually building families and businesses to withstand challenging times. And this brings our minds to the COVID time. I remember during COVID, when we had a lot of lockdowns in some economies, you needed these institutions to disburse funds to you. And some of them you could just stay in your home with a click of a button, open an account, take credit, and pay. This is the sector we are talking about. So, for us to be able to achieve the last mile, which is financial inclusion, our focus needs to be on access. How are we using our system to create the access? Quality. How are we making sure that the services that these institutions develop or deliver are of the highest quality? And central banks and policymaker governments will need to collaborate to look at this. And the next one has to do with the usage. Is it because they are there that we think we are reaching the last mile? No. How are people using it? How are they using the mobile money to bring in other services for their comfort? Again, welfare. Are we looking at sustainability, how they will continue to be our customers? And actually, I looked at the global level and the UN goal, the Sustainable Development Goals, and I asked, these 17 goals that we have, which of them are the MFIs or the NBFIs supporting? Do you have any idea? Which of them are they supporting? You have any idea? I can assure you that goal 1, which is no poverty, they are the ones there. What about goal 2? They are there. Zero hunger. Why? Look at how much they are granting to homes and families to support their livelihoods. These are the cooperatives who are also helping the coffee growers, the palm growers, and other agricultural products. Goal 3, you see they are also there. Well-being. Because they are supporting households. If you have money, you are healthy. Goal 4, quality education. Here's a case where you have some of them granting scholarships. They are supporting building the schools. These are institutions who are also supporting it. Goal 5, Goal 6, Goal 7, Goal 8. I realized that all of them are there. And I left one. Did you realize it? Goal 14, life below water. How are the NBFIs supporting the aqua life? Then I remembered that they are also supporting it. How is it? When you come to Ghana here, in August every year, we have what we call the sea closure to artisanal fishing and large-scale fishing. So we close the sea fishing so that the fish can continue to develop and then you have more harvest in the following years. How are these fisher folks going to live during that closure? This is the period where the non-bank institutions grant them facilities to take care of their homes. So are they not supporting the sea, life underwater? Because they also support it. So in essence, we are all partners, ladies and gentlemen. But notwithstanding, there are certain challenges that militate against these institutions. The issue of regulations that they need to clear, and I am sure regulators in the house will share more light on it to tell us how they are dealing with the issue of regulating that particular sector. The next thing has to do with the limited funding. Because they depend on commercial borrowings, their loans are normally expensive. So it makes households very challenging to access credit from there. Fraud and risk management, depending on the systems they are using. The issue of competition from the commercial banks is also one of the challenges. Technology and connectivity, where they are operating from within the communities, they have these things. And we propose that how do we deal with these challenges? Partnership is the way. We all need to look at how we can partner with these institutions, collaborate with them on education so that we can improve on digital literacy, implementation of credit scoring, and the use of AIs and big data. How we are also ensuring that their security systems. In Ghana here, the central bank has introduced what we call the Cyber and Information Security Directive, which these institutions need to comply to make sure that their systems are robust to be able to withstand the threats. And when COVID came, we saw that those institutions who were ISO 27000 certified were able to cope with the threats. And they are able to deal with fraud and other issues in the system. Look at transparent claims and how their withdrawal processes, public awareness, as well as building the needed environment. I want to conclude so that the experts who are joining me will share some perspectives. And we believe that the way forward is digital and fintech-driven expansion, coupling with the use of sandbox. In Ghana here, the central bank has adopted a sandbox system where you are able to go and test your products and systems as well. The use of hybrid financial models so that you look at the mix and how best you can also collaborate with them, and also how we can focus on climate and agri-financing. So in Ghana here, for instance, the central bank has issued out a directive on climate financing, green energy. And the Ministry of Finance has also have a dedicated unit for green transitioning. And the current government has actually named a ministry as green and transitioning, which tells you the focus, which government and regulators can also look at. Regulations and cybersecurity issues should also be looked at. So in essence, there's the need for smart regulation, technology adoption, and strategic partnership, which we believe that we all have a role to play in making sure that we reach the last mile, quality, access, usage, and welfare. Thank you very much. So we want to invite Dr. Titi from the Central Bank of Uganda, the Supervision Department. We want to share your perspectives. Then we take it up from there. Yes, Doc.
Thank you, Tony Boa. Now, it is like he's presented. It's not in question that NBFIs do have a role in financial inclusion. But allow me to be your typical central banker and try and take the punch bowl away. From a central bank perspective, financial inclusion also does present financial stability risks. And that's a discussion which I think oftentimes gets overlooked in focusing on the benefits of financial inclusion. That's one. Like he said, you know, when you look at some of the challenges he put up, these institutions are providing financial services to persons who otherwise have been excluded for reasons either because of access, geographical access, or because perhaps they did not make business sense, or maybe perhaps, and sometimes that's often the case, because they are indeed a risk in some sense. Now, one of the things in Uganda we have tried to do is deal with the issue of information asymmetry. When you look at the risks of the bottom of the pyramid that the NBFIs address, that the inclusion agenda is supposed to include, their biggest problem is the information asymmetry. In other words, when they interact with the formal financial institution, the biggest problem is for the institution to determine whether or not this person is a good either credit risk or savings risk, or perhaps even a financial service consumer risk. So we are moving so in cooperation with the National ID Agency in Uganda, and I believe a few other countries have already done this, we are moving towards having some form of digital ID. That's one. Two, We are expanding the collection of credit information or credit usage information outside of the traditional, traditional information sources. So we amended our regulations in 2022 to enable for non-traditional financial service providers or non-traditional credit providers, that's to those who provide trade credit, to also start reporting and receiving information from the credit reference bureaus. So that means now you have both traditional and alternative sources of information on someone's credit usage or credit history as a determinant of their credit worthiness. The idea here is to move to a situation where you have outside of traditional collateral, you have integrity collateral. Depending on one's usage and perhaps how they pay their bills, whether or not when they receive trade credit from various suppliers, they actually meet the obligations. That should be part of the information that gets used or included in their credit scoring. So in other words, your credit score becomes your collateral. Your integrity is embedded in your score, and therefore you now have access to financial services, be it credit or whether it's insurance. And of course, the other upside is that now even the pricing of credit is done on a risk basis. Based on the assessment of risk, your pricing is different. That's one. Two, non-banks, like he correctly noted, non-banks do almost operate like financial institutions without necessarily the same level of supervisory focus. Which means now they potentially, if they are mismanaged, can potentially become a source of instability in the financial system, especially if they serve a very wide number of customers or provide significant sizes of facilities. So in our risk-based supervision processes, we have introduced the concept of proportionality, that the supervisory focus on an institution, whether or not it's non-bank or bank, is going to be largely informed by an assessment of its risk, but also its size and impact. The one thing we've done slightly different is, as opposed to giving the institutions the onus or the responsibility of being financially inclusive in their activities, we supervise them in a manner that being inclusive in their activities actually is a plus. So in terms of the risk metrics that we use for assessing their risk, the extent to which your activities, the way you conduct your business leads to inclusiveness has a positive impact on your risk rating. Then when it comes to still the supervisory approach, so we use something called I-SIPs. So I for inclusion, S for stability, I for integrity, and P for protections. The non-banks, because of the nature of the extent of their reach, a major concern is the extent to which they exploit consumers. Now, unfortunately, in Uganda, we don't have a centralized or common consumer protection legal framework. So every regulator, every sector regulator, be it in the financial sector, the health sector, has their own consumer protections. So in our case, what we do is we insist on clarity or truth, to what was something, the equivalent of truth in lending. That the extent, and so far we've been supported by the courts, that the extent to which you interact with the customer and provide them a service, you have got to be able to demonstrate that the customer was fully aware of the extent of both the upsides and the downsides of the product or the service you're selling them. So broadly, that's what we've done as the Central Bank of Uganda. Thank you.
George? You have it.
Yeah, so thank you for your presentation. Yeah, I just wanted to make a couple of remarks. First of all, to say that if I can just talk about the Kenyan context, is that obviously non-banks financial institutions are very important in the whole financial inclusion equation because they're able to reach those in the grassroots, especially those who are clustered around some economic activity, be it tea farming, coffee farming, dairy, fishing, and what have you. And I think for us who are an operator, we've been looking and exploring ways of how we can bring them into the services that we provide. And one of the ways we're thinking about it is by a lower price, simply because they have price sensitive users. They have users who are, they're not going to be able to pay the same thing that a bank user is going to be able to pay for an instant payment. I think the other reality we are working with is obviously the fact that they are not as technologically savvy or advanced as a bank. They work a lot with aggregators to help them with their digital platforms. And so for us is to create a framework that allows us to work with these integrators while managing the risk of having somebody in the middle between us and the financial institution. But yeah, I think when we think about the landscape is that, what do you call it? We probably have about 39 banks in Kenya, but when you look at the non-bank financial institutions, they're probably in the thousands. So when you think about trying to reach the masses, then they become very important if you're going to build inclusivity, if you're going to build anything that's going to have societal scale. They also have very unique needs, if I could put it that way, because what you will find is that the typical person belongs to more than one of these institutions. And they're not only for people who are at the bottom of the pyramid, there are also associations or circles, as we call them, that are formed by people who are in the same profession. So the civil servants have one, the police have one, people who are in the same industry like aviation have one. So you can't really call these low-income earners. They are not. But the reason why they are interested in these institutions is that they offer better financial terms than you'd get from a commercial bank. Within reason, within range. Obviously, they are not able to underwrite the kind of financial liabilities that you'd be able to get underwritten by a commercial bank. Yeah, but they are important, and for us, we are embracing them and trying to see how we can evolve our platform, product, and features to include them. Yeah.
Let's hear from the Somaliland.
Okay, thank you very much. Thank you very much Twembe for the great presentation you have made on the topic of non-bank financial institutions. I would like to point some points about non-bank financial institutions who are common in Eastern Africa. I would like to emphasize about a method of credit rotating or safe and rotating system in Eastern Africa. What I would like to emphasize is that when we are talking about financial inclusion, there are two main things that are very essential to consider. Is the service that non-bank financial institutions are providing, is it affordable to the low-income and small businesses, as well as is it appropriate service for them, for the underserved population? So in Eastern African communities, there is a common credit rotating system, which is informal. And for example, in Somaliland, most of the people are somewhat engaging in this credit, as called Hagbet in Somali. It's a form of credit rotating system which benefits all. why are people are adapting to it? Because it is based on their culture. It's based on what's called their trust. So for my this part of discussion, I would like to emphasize that when we are talking about financial inclusion and promoting for financial inclusion, we have to put some effort on things that the local community understands, and some have an awareness. So utilizing technology, for example, fintech driven, will be more appropriate for those. Because why are people interested to take part the credit rotating system? Because it gives them access to lump sums, which helps the individuals who lack to formal banking to save, as well as to get a credit for them. The second purpose or benefit of credit rotating system is that it has no interest, so it makes it affordable to them. It builds the community trust and cooperation between the low-income people. It also builds the financial discipline among those community. But in the meantime, it carries a challenge, including default risks. So if member of those group who are taking this cooperative fails, the system collapses. Since it is informal, lack of legal protection is also there. The main challenges also include limited scalability. So those people, they work for a limited groups, which can lower the access to a large number. So for utilizing technology, some digital platforms has also already started supporting those communities. For example, in Somaliland, they started a service called Kaitso, which means save to yourself, where individuals and businesses will save a small amount of their daily income, so they can withdraw until the end of the month, so they can support family expenditure at the end of the month. Also, M-Pesa has offering in Kenya and Ethiopia similar services on those things actually. So empowering those community organizations who are informal and out of the service using the technology may uplift those underserved to the banking system. The challenges has been taken by Boyke. For recommendations, the main recommendation I have is to encourage digital financial service, so to lower the transaction costs and build consumer protection for those protecting fraud and exploitation of those, as well as promoting financial literacy among those underserved population to have some sort of saving and credit and access to the formal financial system. Thank you.
Thank you very much. A lot has been said about what these non-bank financial institutions would do, but I would just look at them from a structural viewpoint. In most countries, the non-bank financial institutions are mainly in three areas. There are those who are looking at social transformation. Most of them, like in my part of the world, they come from organizations such as churches and NGOs, and they are looking at developing the social aspect of the things you are looking about, your 17 goals. However, there is another growth of non-bank financial institutions that are actually covering the gaps that commercial banks did not. And you mentioned some of them, like cooperatives and such. There are others which are also guided towards specific areas of the economy, like agricultural finance corporations, which is targeting farmers and such things. Now, the unfortunate thing about the structure of these is that since they are not regulated, their governance structures are not very, very sound. So you find the sustainability of these organizations is actually not very sound. Some of them don't last very long. A lot of them, because of the fact that they are not regulated, end up actually not being able to serve the sustainability or inclusion agenda. For example, in Kenya, we had a lot of mobile, because of the advent of mobile banking, a lot of digital, we call them digital lenders. In other parts of the country, they are also known, or the world, they are also known as payday loans, where they offer you loans and then you can repay when you are paid your salary. Unfortunately, those end up being very, very profit-driven, and their interest rates are very crazy. You could hear things of 30% interest rates, and because there are people who are actually not banked in the commercial environment, they have no option but to go to them. So they end up actually being over-indebted, and the development in Kenya is that the central bank has been forced to actually regulate those digital lenders just to make sure that people don't take advantage of that. A lot of lenders were moving into the financial industry with the sole purpose of just profiteering from those payday loans. So that is another unintended consequences of this. The other issue we are talking about, inclusion, is not just about the inclusion in terms of the service offering. It is in terms of the interface between the banking economy and those microfinance and non-bank institutions. Because at the end of the day, the transactions will happen, but the commercial banks will end up funding or financing or banking those transactions. So we are looking at things of development areas now called embedded finance, where, for example, a bank will partner with a non-bank financial institution to offer a service that a bank could not offer. So you get things like agent banking, where a bank that is not able to open a branch in a very remote area will partner with, for example, a shop, and they can offer limited financial services that a commercial bank will then underwrite and ensure that compliance and all those aspects of consumer protection are taken care of, but they are able to serve the consumer in some element of financial inclusion. We also have things like bank assurance, where banks are partnering with insurance companies to either underwrite a financial institution's capabilities, and then banks can use their branch networks to sell insurance and improve. For example, in Kenya, we saw the penetration of insurance products improving because banks have partnered with insurance companies, where people are not bothered about insurance. If you are now taking a mortgage, then the bank would also cross-sell an insurance product with that particular mortgage, and therefore the uptake of insurance has actually increased by about 3 times since the introduction of agent banking. So you are starting to see quite a mesh in that. The unfortunate scenario is that then the regulator is now almost conflicted, and I think my central bank colleague will agree. There is a mix of regulations. So where the central bank is focused on regulating banks, suddenly the bank is involved in insurance. They're also involved in other facilities that are not necessarily commercial banking business. And so you are starting to see a graying area of commercial bank and regulation in terms of what other banks should be able to do to expand their business offering. So it is becoming a very complicated area from a market standpoint, and we are starting to see a lot of gray areas of products between non-bank financial, and the central bank is now being forced to look into areas that they previously did not. They are looking at non-bank, but the number of institutions they are going to license is becoming a problem. The other issue we are seeing is credit facilities. A lot of people who are not exposed to credit are suddenly being given credit. So when a non-bank financial institution opens in places where people are not used to, a lot of people are taking credit thinking it's cheap or it's free. And therefore they end up being over-indebted, and then now debt management becomes a problem. And this is where financial literacy becomes critical for players who are looking to go into this space. Because very soon, yes, you are going to lend to all these people, but collection becomes a problem. So I think we need to start looking at responsible lending and sustainability along with the development of non-bank financial institutions developing the agenda of financial inclusion, so that even as we include the obviously low in the pyramid, they need to be alerted about the entanglements in terms of credit, financial literacy, and managing their financial affairs to ensure that they can sustain themselves with whatever income they are making. So those are the comments I would make, and we can discuss later.
Thank you very much. Please, they deserve a clap. They deserve a clap. Let's take some comments, comments.
Yes, thank you very much. I'm Jean Bosco Yachu. I'm CEO of Access to Finance Rwanda, part of the FSD network. We are promoting financial inclusion and financial sector development across sub-Saharan Africa, present in 10 countries. This is a topic that is really close to my heart because that's what we do every day. And thank you very much for the brilliant presentation that really highlighted all the contribution of this new category or different category of financial institutions. And I want to share that when you talked about NDA, non-bank, for us in Rwanda, we call them NDFIs, non-deposit-taking financial institutions. And that's where we see fintechs. So we have quite a number of fintechs. And other institutions that were doing shadow banking that now, because the regulation is there, they have started to offer financial services openly and under a governance structure, which is much more appropriate. And that is really challenging the incumbent banks that have been there, but also they are really trying to close the gap that we see. Now, from data, clearly last year, there's a study we have every 4 years, a survey, which called FinScope. I think in other countries, FinAccess in Kenya. And what we saw is that mobile money was a key contributor to the inclusion shift that we saw. Banks were not actually serving a lot, especially the low income, reaching the underserved and unserved. Even these non-bank financial institutions weren't doing much. So mobile money was actually the highest. Now the problem with mobile money is because they are focusing mainly on payments. And we want to see more financial services actually driven through that channel, which seems to be very convenient to many, to majority, especially in East Africa. Now, the problem I have, or probably the challenge, they've talked about different challenges, but when you talk to these particular institutions you mentioned that are serving really the low-income people, you'll find that, I think you said it, that they charge high. And when you ask them, they will tell you that they have high transaction costs, or the source of capital also is very expensive. And I'm trying to, other issues around sustainability, I think are there because I've worked with them. Some of them have been there actually because of subsidies that are coming from the donor community. If you were to withdraw subsidies, most of them would collapse, which is really non-sustainable business models. And that really worries me. Yet they are serving a constituency that is very important to us. Now my problem is, and I'm trying to connect this conversation with, why we are here this week. Moja Loop coming, and the conversation we're having in our country is that, yes, all the commercial banks I have hooked to this platform, but talking some MFIs, large ones, fintechs, but there's so many, those small ones, medium and small ones, that can't. And that becomes a problem because those are the ones serving the important people that you want to see in this particular platform because we want it inclusive. Now the issue is when you dig deeper and try to understand, you find that they have very weak IT platforms. And to me that becomes, a weak point for them to connect, because you don't want them to bring that risk to the entire ecosystem. Now, who will fund that? And when I was recollecting my memory around open source DPGs, there's actually Mythos, and I was trying to see Mythos being there, open loop. Can it, because it could be cheaper, because really all these MFIs and the small MFIs and circles cannot actually afford those robust platforms because they are expensive. Now, can actually this open source platform, Mythos, be probably the saver to actually reduce the transaction costs and then make them actually hook to this interoperable platform? So that's really something probably is a question that I want to know. But the last one is that actually among that category, we have fintechs that are actually providing financial services. And those ones, as long as the banks accept to integrate with them, especially through an interoperable platform, then that brings actually a solution to that problem that I was talking about. And we see that as probably something that will be highly transformational, and I think we should support such. Because to me, you mentioned about a challenge of competition from banks. I don't see it as a challenge to me. I see it as healthy evolution of the market, so that actually everyone steps up to serve the underserved. So that's probably some of the reflections that I had, and thank you very much for this conversation.
Thank you very much. Doc, you want to make a quick interjection?
Yes. So there was an issue raised by my colleague here about the gray area that's beginning to form, and that's one of the reasons. At least I'll talk about Uganda. That's one of the reasons why we have focused on risk. We're saying we are not going to tell you what you can and cannot do. Just demonstrate to us, one, that you understand the risks, two, that you've got an effective risk management mechanism in place, and three, that either you're holding capital or have someone, a person ready to handle or deal with the residual risk of whatever activity you're doing. You see, when you take a risk-based approach, then you kind of stay away from being prescriptive. So in the case of Uganda, for example, when you open a bank account, the same bank is going to try and tell you insurance. The same bank, so they have bank assurance, they have pension products, they have investment products through the capital markets. So the bank becomes a one-stop center. But at the back end, and here's the interesting part, for maybe perhaps with the investment, there is either a fintech or some other non-bank they have partnered with to provide you that service. Okay? So as a central bank, I say, you have that arrangement. What I just want to know is how effective the efficacy of your third-party risk management framework with that third party. Are they introducing risk? If they have access to your core banking system, what does it mean? And that kind of solves the issue we're talking about of saying some of these non-banks don't have the ability for the technology. They should be able to leverage, and I agree with him, they should be able to leverage, the non-banks should leverage the banks who have the capital and the systems. If you're providing a unique service that's a value add, so that on the list of on the menu of the bank services is one of those you provide, you plug in and do so. Then as a regulator, I don't ask about you, I ask the bank. You have given him access to provide a certain service as part of your menu. How well are you managing the risks that either he presents to you or she presents to you, or the risks to the customers who are going to consume these products? I'll give an example. One of the banks in Uganda, about 35% of its loan book is actually on digital credit through mobile phones. 30%. Okay? So as a central bank, we don't tell them, no, that's too much, that's concentration risk. All we merely ask is, how much capital do you have in place, and how are you properly managing the risk that having 35% of your loan book being to a group of almost 2.5 million subscribers who are not even account holders, but are managed through a telco and two different fintechs. how are you managing that risk? So I think the opportunity on financial inclusion comes from non-banks and banks, first of all, agreeing that actually they are not competitors, that they are complementary. And then the process of them complementing each other's efforts becomes easier. Thank you.
Thank you very much. Well, I think we all deserve a clap. We all deserve a clap. I'm sure the conversation will continue. We have 3 days here. Tomorrow we'll continue, and Wednesday. I don't know if you may want to have some closing remarks. If not, all right. So these are some few conclusions that I drew from the various comments, that there's the need for us to look at the regulations well, but it should be on risk base. And that is something that I've seen, that smart regulators across the globe have adopted risk-based supervision, so that you do not use a sledgehammer on something that has no risk. And we want to encourage that. And all the conversation, we realize that Mojaloop platform is a key enabler that we will need to look at for adoption at the various levels. And then there's the need for us to know that the sector we are talking about has a peculiar need, and they serve a specific, a unique market. Culture and trust play a key role, and there's the need for us to look at how the systems, governance, framework are also enhanced to make sure that, not that we are serving the lower tier at their own detriment, but the systems we put in place and the structures actually work to their well-being. And I will encourage all of us to continue to have a second look at the non-bank sector. Thank you very much, and have a good evening.